Kirk Barneby, the yield on the 10-year Treasury has risen from 1.7% back in January to 2.4% today. How much higher can it go?
Greg, I think the 10-year can go significantly higher. If you simply look at the relationship between growth in nominal gross domestic product and the yield on the 10-year, it's a very significant positive correlation over time. So if we think about 2% real growth plus 2% inflation target, assuming the Fed can engineer the economy smoothly to that 2% target rate of inflation, that would imply a 4% yield on the 10-year in longer-term equilibrium. So again, the short answer is it can go higher, and if we overshoot with respect to inflation, it could go meaningfully higher.
Well, we'll talk about the Fed in a second, but what I want to know right now is how you manage your actively managed Treasury Fund in this environment, which could get a lot more volatile.
We adjust the duration of the portfolio, Greg. So currently we are significantly shorter in duration than the duration of our benchmark, which is the Treasury market itself. So our active management involves the active adjustment of our duration with a monthly review process, because even in periods of significantly higher rates or periods during which rates are rising significantly, rates won't always go up each and every month. So we want to have the ability to have a very short duration or perhaps go to cash, but with the flexibility to re-enter the market if it looks like there's an opportunity.
Can you talk about the amount of foreign buying in the market? Because this is something we hear repeatedly, that it's foreign buyers that are keeping our rates low so the Fed doesn't have to go on with its quantitative easing program.
Well, foreign buying can have an impact at the margin, but foreign buying is not going to keep rates significantly below where longer-term equilibrium, inflation, and growth conditions suggest they should be. So can foreign buying have an impact at the margin? Yes. Is it going to keep rates permanently lower? Very unlikely, particularly if foreign rates begin to increase.
And speaking of keeping rates low, thanks for the segue again, the IMF chief, Christine Lagarde, says she wants our Fed chief, Janet Yellen, not to raise rates until next year. Can you talk about the interplay between these two women?
Well, I don't know about their personal interaction, but from an economic perspective, I hope that the Fed does not, in fact, delay until the beginning of next year, simply because if you look at the concept of the shadow federal funds rate, for example, it would suggest that there's currently a gap of about 300 basis points between where a Taylor rule as a guide to the conduct of monetary policy suggests rates should be, and where rates based on quantitative easing, the shadow rate, suggests that the funds rate truly is, assuming the funds rate could be negative. So with a gap that large, it's probably time for the Fed to begin increasing unless we're going to get significantly behind the curve.
And that time will be, in your estimation, September, right?
Yes.
And why is that?
Simply because there is a significant gap. If you look at labor force conditions indicators, there is a very significant, strong momentum in labor force activity, and the level of economic activity has also now reached a point where the unemployment rate is, if it's not at, Greg, it's very close to what you think of as NAIRU, the non-accelerating inflation rate of unemployment, or the rate of unemployment that the economy can maintain over time without causing an acceleration of inflation. So we are, in fact, probably close to being fully employed, if not fully employed. Labor force momentum is positive, and if we wait until you get to the point where we're overly employed, if you will, then again you wind up behind the curve, and it makes it more difficult to control economic growth, to maintain inflation at its target. You run the risk of overshooting, and that then of course would lead to increased need for tightening further and maybe raise the risk of recession.
All right, thanks a lot, Kirk.
Greg, thank you.
And thank you for watching The Street.